Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour with the S&P going for its best week in a month. We'll ask the investment committee today if buying the dip in stocks is the best strategy right now. Joining me for the hour today, Josh Brown, Stephanie Link, Jenny Harrington here as well. We will check the markets today. Stocks are mostly in the red. The NASDAQ, of course, is positive. Thank you, Apple, which continues to follow through on yesterday's big gain. You did have New York inflation expectations, which were higher. You did have a pickup as well in concerns about the labor market. Maybe that's weighing on some stocks more than others. Reciprocal tariffs are now in effect. Josh Brown, on that note, UBS today says the fundamentals look to keep the market supported despite tariff impacts. Our base case remains that the effective tariff rate will settle at around 15%, enough to weigh on growth a little bit and lift inflation, not enough, though, to derail the economy or the equity rally. You agree?
Yeah, and I think the reason why is because the stock market is not identical to the economy. I think the effect of these tariffs will be felt far and wide. They are not completely inconsequential, but for the purposes of looking at the S&P 500, they just really aren't a powerful enough countervailing force to offset what's happening with the AI CapEx story, which at this point is the entirety of the S&P 500's earnings growth story. Lots of companies are growing earnings. Lots of sectors, 8 out of 11, have earnings growth this quarter versus the same quarter last year. But in terms of like the sheer volume of where the earnings growth is expected to come from, we know where it's coming from. It's high-end consumers, it's the upper middle class consumer, and it's AI CapEx and all of the related infrastructure build out. And so long as that remains intact, it won't be for forever, but right now it is. It's tough to see a situation where the dips don't get bought. And when you look at the way investors are buying dips, putting money right back into the S&P 500, right into the triple Qs, right into the most speculative stocks in their brokerage accounts, they're not focused on tariffs as being like the driving force behind what they think is going to happen. They're focused much more on the bigger theme that we talked about. I don't know what changes that, but that's where we are today.
So speaking of buying dips, Steph, I mean, you are emblematic of that. Whether this is the right strategy or not, you believe it is. You are buying more. You're buying more Chipotle. Now, I wondered when you were going to do that. I figured you probably would because that's in your DNA. You look at stocks like that have come down a bunch. You think it's not justified. You buy more. Yesterday on Closing Bell, you told me you're buying Eaton and Rockwell. You thought they were punished unfairly.
Yep.
Ridiculous that those stocks traded down on what you thought were pretty good earnings. Take me through the Chipotle one, since you told our viewers yesterday in the afternoon why Eaton and Rockwell made the list.
Yeah, and it's not every stock that I'm buying on the dips. It's where I think the fundamentals, either short-term or long-term, are misrepresented. Chipotle's going to take a while. I think it's going to be second half of the year story, maybe even into 2026. But after I saw the challenges in same-store sales at Shake Shack, Wingstop, Starbucks, and others, this is not a Chipotle same-store sales problem only. It's a problem, but I think it's going to get resolved because they have growth drivers. They've got new products, they've got technology, they have digital. Most importantly, they talked about June ending on a strong note, which is a good thing, with better traffic trends. They have the products that people want. And actually, they have a decent pricing strategy as well. And they still have high single-digit percentage unit growth. So not cheap at 30 times versus 40 times historical, though. Growing earnings at about 20%, and it's down 29% on the year. It's been a horrible pick on my part. I'll admit that. But it was like, do I sell it or do I buy it? And I had more conviction in buying it for the longer term, with all the reasons I just mentioned to you. Because I think you're going to see a return to growth, a return to traffic growth, same-store sales. Margins are best in breed, and they have the products that people want. And the valuation has come down to a reasonable level, given what they're going to grow going forward.
You ever wonder whether the best days are behind this name?
I don't think so at all.
That there are just other offerings that people are more in tune with now that they like better?
They're in the top 10 QSR. They only have 3% of the market share in a $400 billion industry. So no, I think there's room for a lot to grow. And again, this is not every single stock that falls that I want to buy. This one's probably the hardest, actually, to be honest with you. And United Healthcare is also
why I'm asking
the
those
other
questions.
one's hard. Right, that's right.
Right.
Sometimes buying hard makes a lot of sense because everybody is on one side of the boat, and I'm trying to be kind of like in the middle of the boat. I don't necessarily need to be by myself, but I would say the two names, United Healthcare and Chipotle, are the two hardest to buy, and the two things I believe to buy for the longer term. I think it's the right thing to do. In terms of the Rockwell and Eaton, we talked about it yesterday, but industrial electrification is on fire. And I looked at those numbers, I could not believe the reactions. Now, they ran a lot, we talked about it, but when you have Rockwell increasing core earnings by 51 cents, that is crazy. The stock was down 9%, margins expanded over 200 basis points. Eaton, we talked about data center, 80% is electricals around the world, and that actually saw 55% order growth. That's visibility. So to me, I'm picking my spots, Scott, but I have a little bit of cash. We did sell something we can talk about if you like, but did sell some.
We'll get there in a minute.
No, we can talk about that, but I don't have...
We're going to get to another thing you bought more of in a minute, because it does play into this story. I want to hear from Jenny, though.
I was going to say, in response to, like, has it played out on Uber? If my teenage kids who are 16 and 18 are anything, representative, no, it hasn't. It's still their favorite. With everything else out there, with Kava, with Sweetgreen, Chipotle is still #1 for that crowd. So anyway, that's all I had to say on it.
That's all you had to add?
That's all. Yeah,
all right, great. Josh, did you have something that you wanted to add?
Do you think the sell-off in Chipotle is justified, but now it's like a lower risk entry because of how much market cap has already been lost? Or do you think like the fundamentals are good and the sell-off is not justified?
I think that they've had a speed bump, but I think the industry has had a speed bump. April and May was really, really challenging for the consumer and sentiment. Remember how negative and gloom and doom everyone was? So of course you're not going to go out and buy 5 different burritos each day, right? I mean,
speak for yourself.
I mean,
but when you said it was in Steph's portfolio, I was going to make a joke, and it's in Josh and my belly.
I don't do. Your mic's falling off. I don't personally do Chipotle, but to your point, my kids and all of their friends, that's their go-to. It's like second nature.
It's incredible.
So the RSI is 24. So tell me about that,
That's
right?
Just washed out. I mean, it's a falling knife. It's the United Health of Mexican food.
Of course, and I can't have too many of those in a portfolio, but I'll have 2 or 3.
What turns it? What turns it? What are they? Is there anything they can do, or just the consumer has to come back?
Before you answer the question, and I don't know the answer to this question, can we show a performance Chipotle year to date maybe versus a Kava, for example, because I feel like there might be something to that conversation, but you can answer the question.
The stock is down 29%, Scott. It is where the kids are going. They do have the traffic. They have very easy comparisons, by the way, in the second half of the year, so that'll help them as well. But they do have product initiatives to drive more growth. They still have, I said it before, high single-digit percentage unit growth. Name me one other company that has that kind of growth, in addition to best-in-breed restaurant operating margins. And you add it all up, it's a falling knife. It doesn't look good. That's okay.
Kava doesn't look good either.
The whole industry has struggled, and I'm trying to find the best in class in the industry. I'm not saying that Kava isn't, not saying that Shake Shack isn't, but I think that Chipotle is a value here, especially given that it's down so much, it's washed out, and no one's even talking about it, which I kind of like too. I'm going to stay patient with it.
But Steph, when you say it's a value here, like that's the one part where you
relative
diverge.
Relative value.
And I think what
I have 35 times forward. What do you have?
That's the problem.
At 30 times forward, it's 22 times EBITDA. It historically is traded at 29, 30 times EBITDA.
I know, but I think that historically is where we start to get into trouble here. Wow. And if you think about the portfolios that we manage at Gilman Hill, there are a lot of these, like they have a decent valuation, decent absolute, decent relative. But in this market, all the investor dollars are going to AI. And it's hard to fight.
I have plenty of that.
I know, but I think then when you see that 35 times, it just becomes insurmountable.
Well,
it's grown 20%.
Yeah,
but even 25%.
Like the argument I was having a couple weeks ago with Kevin Simpson. What's going on? Sorry. It's almost like the argument I was having with Kevin Simpson on Palantir.
And you know what happens.
I get kicked off the show.
You're out.
Headset.
Oh my God. sad?
Yeah, it's sad.
Okay, so I'll spend the rest of the show like this.
Okay,
But when we were
whatever
talking about
it takes.
Palantir,
Whatever it
and
takes.
Kevin was saying Palantir's earnings were up 39%. I'm like, yeah, 39%, but it's 150 times earnings.
Yeah, but this is not 150 times earnings.
No, it's 37,
Okay.
but it's 37 for a slower
It's
grower.
30 times for forward estimates.
I just
30
think it's
times.
still a rich
and historically,
valuation.
it's traded at 40 times. I'm not
Everything
saying
else I
it's-
agree on.
I'm not saying it's absolutely cheap. I'm saying it's relatively
Are you looking
cheap.
at it
And I
versus
do
like a
look at
Starbucks? Because I think
I have better growth.
like it's Chipotle has faster growth, but Starbucks similarly has the potential for a turnaround here, and the valuation is more reasonable.
I don't know if the
I'm not
valuation
in
is-
either stock. I'm just curious.
Yeah, no, I mean, the valuation is like 25 times, and you're not getting 20% earnings growth, and you still have a turn. Now, I'm intrigued by that because you know that I like to do that,
The
especially with the
market's
great.
intrigued by your argument, obviously.
Well,
look at it.
Chipotle's up.
I don't
She's
know.
a hitter.
What
odds of the day
I
for
don't know.
CMG?
I don't know. You just gotta. A year from now, I think it'll be
Here's
higher.
a potential catalyst. Pershing Square comes back. Taco Bell rides again. I don't know. I mean, this stock, we've counted it out before, and it's one of the best investments I've ever seen anyone make. When Pershing Square came in during the food safety crisis, I think he had a 5X in the name. Like, I don't know if you have the same potential from today's valuation, but we've counted this company out before historically, and it's had some huge comebacks. I wouldn't say it's out of the question. So
This does raise the issue, the overall issue of stocks that, like an Eaton, for example, as you said, or maybe a Rockwell or others that have had pretty good earnings.
Yeah.
I'm not saying Chipotle did.
No, that's why that one's the hardest. Yeah.
But the idea of good earnings, bad price action, that's what led you to say this is absurd with the Eatons of the world. Does Uber fall in that category?
Well,
because you bought more of that, right?
Yeah, and
Their target goes today to 120 at Goldman, target to 117, UBS. There's obviously a lot of love on this program for that name, but is that one of those stocks too? Good earnings, bad price action, pounce on a dip?
It was down 5% in the pre-market, and I thought that was absurd because I'm looking through the report, and all-time high in frequencies, profitability, customer count, mobility, delivery. They've got a whole new product set coming. They have a $20 billion buyback, and the thing was down 5% pre-market. And then it was down about 3% all day, and so I just added to it as well. It's a verb, and it's where all
They
all
bought
the
it.
kids
They bought
do.
it. They spent the whole day buying it back.
I know.
The pre-market sell is like algorithms.
I know, but
they don't even care.
It didn't like I thought it was going to be up 5% after I saw the results, and then when
Two
it was
reasons
still
why it
down 2 to
wasn't.
3, mobility was a little.
Two
sluggish.
reasons.
I know,
Two
but-
reasons why it wasn't. I thought the numbers were solid. I think the street really wanted to hear about an expansion of the Waymo partnership into a third city, and Dara didn't have it. He may have it tomorrow. He didn't have it for the earnings call. I think the street is like, okay, Austin's great. Atlanta seems to be going really well, although it's early. Who's next?
And
they didn't have it.
And I agree with you, which is why I bought it, because I couldn't believe it was down on such a solid report. And we know all that stuff is coming, Josh. Sorry.
No, but you know what I wondered? I wondered if actually the share buyback was interpreted like as a bad thing. Just a little bit.
I don't think so.
I'm not sure.
How and
but
why?
Because why aren't they
Usually
investing
they
Right,
never-
because if they have that
growth?
much cash flow, like think about the reason we bought it, right, was because it was going from negative cash to exploding cash flow. $2 billion the first year, $4 billion, now we're up to $8 billion. What do you want that as a growth investor? What do you want them to do with that cash? You want them to invest, and we know that they're going to have challenges from driverless cars. They're going to have challenges from Tesla, and so I really wondered: was there some interpretation of I'd rather see you use that $20 billion to reinvest and make sure that you are as competitive as you can possibly be? That was just my response.
So
when I was
I'm
listening
on
to
the other
yesterday.
side of that. I think that would be a huge mistake for Uber to go whole hog into some sort of OEM situation where they're buying cars. And one of the things that, if you read between the lines,
Josh,
Dara was
I
talking
agree.
about, hold on one sec. The value of autonomous driving is not going to accrue at the car level. The cars are washing machines, okay? They're microwaves. The private equity companies that are ringing Uber's phone off the hook, they want to own the fleet. And then Uber is going to make its money connecting drivers to those fleets. Fleet management is not going to be a sexy, high-tech business. It's literally going to be appliances. So I don't think that would have been bullish. I think the $20 billion buyback is bullish because I think it demonstrates confidence. We are generating so much cash flow at this point. We can A, do our CapEx, B, do M&A, And 3, return a lot of excess capital to shareholders. And one other thing jumped out at me, Jenny. Love to hear your take. 36 million Uber One members. And here's what you need to know. Uber One members, people who are paying a subscription price to Uber every month, like myself, spend 3 times more and 35% higher retention than regular single service users. And they're also finding that those people are utilizing lots more services on the platform. If they can get that number over the next year or two to 50 million paying subs, now we're having a Netflix conversation.
Right.
We're not having a taxi and limousine conversation.
Right. With I think one. Okay. So when I said that on 20 billion, I was just saying, like, maybe this is why it's trading down, because I couldn't make sense of why it traded down either. Josh,
it's up 55% year to date. It's as simple as that.
Maybe that's all it was, but I wondered if that was misinterpreted.
Well, what about the broader idea of buying dips?
Right.
Now, retail has been a really key component in keeping this rally as resilient as it's been. Retail's been more right than institutional investors in many regards throughout this whole thing. Mm-hmm. Is that starting to wane? Interesting information today from JP Morgan's Retail Investor Radar. Lukewarm retail activity during the market dip. Retail buying only amounted to a modest $1.6 billion on Friday, August 1st, $1.2 billion on Monday, August 4th. That compares to a $3 million average of $1 billion and the March-April peak of $4.7 billion. Is retail getting tired? Is retail getting exhausted? Are some of these moves in lower quality, higher beta, culty things playing themselves out? Is that something to be concerned about?
Retail might be tired, but institutional, they're all behind their benchmarks because they were not buying in April and May, right? And so now I think they're chasing. And it's okay if retail takes a pause. There's still $7 trillion of cash on the sidelines, however. I don't think it's all coming into the market, but that's supportive. Scott, we talked about $1 billion year to date of buybacks that have been announced from companies, a record number last month alone. So you have that as a tailwind as well. And then I think you go back to fundamentals. If the stocks pull back enough, I bet you retail will be right back in there, because we have learned that it is all about AI and all about data center and all about cloud and all about power and grid and that sort of stuff. And there's so many ways to play it, but maybe those are a little extended. Maybe we take our time in August and September, seasonally slow months. But then I think you set up really strongly for 4Q.
There's money coming in from investors all over the world. Very paradoxically, at the same time, the global macro hedge fund people are talking about this concept of liquidity leaving the United States because of the tariffs. Then we get data from the St. Louis Fed that tells us private investors, so not sovereign wealth funds, not central banks, private investors buying record amounts of U.S. securities, and not just T-bills. They're buying U.S. stocks, like in huge numbers. I don't think that kind of thing stops on a dime. So not only do you have this bid from the retail investor that does not seem to get satiated and comes in on every dip, whether the institutions do or not, now you have private investors from all over the world increasing their exposure to U.S. stocks, largely because their economies are doing well. And they see this as an opportunity when the market falls.
And because you think, Jenny, that the tariffs, which sound bad by headline, aren't as bad as that sounds. I mean, look at the tariff announcement today on the chips, right? First of all, reciprocal tariffs went into place today. You have the president talking about 100% tariffs on chips, except, and that's the most important word of the day, if you look at the activity in the chip stocks, the carve-outs for the companies that are announcing the foundries that they've already announced to build their stuff here. Why do you think NVIDIA is at a record high today? Why is Broadcom up? Why is Micron up? Why is Taiwan Semi up? Why is AMD up? Why? Because the market likes the carve-outs, and so does B of A, as they talk about the impact of tariffs not being as bad. Less than meets the eye, they say. It removes the overhang. From a high level, the 100% headline number seems intimidating, but in practice, we expect a much lower impact as major foundries such as Taiwan Semi, Samsung, Intel, and major other companies have committed to building significant U.S. manufacturing footprints here. NVIDIA's target goes to 200 today by Goldman Sachs. That's part of the story, too. Bark, different from Bite. Bark, different from Bite. right?
Yeah, absolutely. And I think that's why the entire market's up that much. It's why we rallied, straight off of the Liberation Day lows, because everyone saw that he was going to back away and that we weren't really going to be stuck with the 30% that we were at as of the end of March. Now we're at this 15%. No one believes the 15%. I still think that there's risk. I think there's risk that supply chains do get messed up, that some tariffs are high. It hasn't worked its way through the system. I don't know how that works, and works out in the end. And I think when we talk about how people are feeling about it, our client base, yeah, they're fully invested. We talk about that all the time, but at the same time, nobody feels good. So people are wary. People are uncomfortable. They're all happy that they've made money, but they don't feel good about the way it's been made.
Their leader, you, has not felt good about the market. So maybe it's
a chicken and an egg.
Maybe that's trickle down feeling badness.
Maybe, but maybe it's a chicken and an egg. Maybe that's why our clients come to me, because they sense that hesitation, right? I don't know. But I don't have a sense of a rah, this party's flying along.
But what if,
I have a sense of a begrudging, we're happy to be up, the government's going to support this market, right? We know they're going to back away from tariffs, but there's
I don't
uncertainty.
even know. What if they don't back away? You get 15%, but then you offset it with lower taxes and deregulation.
Well, hold on, not lower taxes.
Well, lower taxes and a known, so that companies can use all of their money and free cash flow to invest and build out their business, and that leads to better growth. I mean, what if the tariffs actually work?
Right, and that's why you stay fully invested.
Right.
But it's not rah-rah.
I think there's a dichotomy, though, between different investors who are focused on different areas of the market. So I think there is a huge component of 27-year-olds, 32-year-olds. They're praying for dips, because every one that they've bought over the last 15 years, since they were 22, it's been an incredible opportunity. And they're in the Palantirs of the world, and they're in the Joby Aviations, and they're using their imagination and buying companies where they say to themselves, yeah, I don't care if this goes down 50%, I'll be fine, because this isn't I'm not 70. It's not my whole net. I'm still accumulating shares. I see that attitude every bit as much as I see what you're talking about, which is people who are all right, I guess it went up. I don't know how it went up, but it went up. I see both, but I think there's a demographic separation between those two mentalities. So,
Steph paints a picture where you can easily, or certainly more easily, see why stocks have been at record highs. Now, we've been in a little bit of a doldrum period, and there's been an undeniable lull in what's happened. Why? Well, the jobs revisions raise some serious questions. The path of the Fed raises some serious questions. But Steph goes down the list. Deregulation, better growth. Those are legit.
They're legit, and I wouldn't call it a doldrum. But I wouldn't call this a doldrum. I would call this a digestion. And I think that's probably the right way to look at it. Why have we kind of plateaued at this +7 to +9% on the year level?
Well, because we had a massive run off the April low, and we needed to relax.
But it's not a doldrum. We're still up 9%, almost 9% on the year. That's not a doldrum. That's just a digestion. And maybe we just consolidate. Maybe we're in the process of consolidating that 23 times and getting to the best case that Steph paints. Maybe. I hope so.
We'll see if the dips continue to be bought.
MSCI ex-US is up double the S&P 500 this year. What's happening is very much a global phenomenon, and I think it's really important to look at charts, look at South Korea, look at India, look at Europe, look at the UK. You've got strength, Japan. You've got strength in gigantic markets all over the world. I think it's transcending just our concern about U.S. jobless claims from last week. I think it's a much bigger phenomenon of people really thinking about the future, a lot of these CapEx build-outs for various things, and wanting to be a part of it.
Well, you have stimulus all over the place, around the world, other than in the U.S. So just imagine when we start to stimulate. I think there's better value here.
So we're gonna take a break. Welcome back. President Trump expected to sign an executive order today to allow private assets and crypto assets into 401ks. Yes, it's a great opportunity for private equity to have access to these funds. For our purposes, I think the bigger conversation for us is to whether this is good or bad for investors. Josh, this is in your wheelhouse if ever an issue was. What do you think about this?
I wrote a 3,800-word blog post about this on Monday. So if anyone wants to go to Downtown Josh Brown and get my expanded thoughts, but big picture, Judge, I like the idea of there being choice. I just question whether or not, if we all agree it's very hard to pick an active stock mutual fund in advance that's going to outperform, and I think most people would agree that's not easy to do. The amount of dimensions of things that could go wrong with private markets is like 10x. So I would equate picking a public stock mutual fund to playing chess. This is like a 12-sided Rubik's Cube. You've got liquidity issues, you've got opacity, you can't actually do due diligence on the underlying assets. You really have to rely on the fund sponsor to do that. There are a lot of different reasons why most people don't need this. That being said, if you're dying to have your money, at least a sleeve of it in private equity, private credit, there are probably worse ways to do it. You do it in a sleeve of your 401k and the fees aren't egregious, maybe it works out. My personal opinion is it's a nice to have, not a necessary to use.
The individual investor already has access to these products. They haven't had them through their 401k or retirement plans, but they have had access to them.
High net worth people have
yes,
had
but
access
even lower net worth through platforms like we go out to the CASE conference every year, which is a platform that connects the asset managers like the private equity firms to the RIA community, so that the regular Joe.
These are for $500,000 allocations. Now we're talking about a 401k. A person allocating $5,000.
I understand, but there's a definite difference between the two.
Yeah.
But this is not the first foray that regular investors have had into the alternative universe. This just ups the ante when you start talking about retirement plans.
It does, but also you can buy these through BDCs. You can buy Ares, you can buy Sixth Street Lending, which is what we own. You can own some of the Golub funds, and you're getting access to private capital, to private credit, right, through those. Why not go that way? Hercules,
well, in a 401k, people aren't buying individual tickers. That's why. The point is,
fine,
it's an $8 trillion honeypot. The 401k market, it's $8 trillion. If private equity can get to 5%, they're at zero now, okay? 5%. That's 400, I mean, we're talking about $400 billion, and the fees on these funds are substantially higher than the funds that are traditionally used, like life cycle funds or index funds, which are 3 basis points. Now you're going to have people paying 100 basis points. Well, what are they getting for that 100 basis points that they weren't getting from the plain vanilla index? My question is, like, you really think that's the route to outperform the S&P?
Well,
No, not
it's
at
a
all.
diversification tool.
Okay.
You have to
maybe
asset allocation, like 5%, 10% max in terms of exposure to private credit or private equity or private markets in general, especially given the liquidity. My concern is I'm not sure. Lack thereof,
Correct.
right? Like that's what bothers me, because I'm not sure private investors or retail investors understand or appreciate these are long-tailed assets. You're not getting your money back for a very long time. I know it's 401k, so maybe they're not expecting that, but this is not something like I can just go sell tomorrow.
No, but the other side is that the world's evolved. I mean, people are looking for different kinds of assets beyond just stocks and traditional bonds.
But they're not going to be uncorrelated.
Right.
So this is unfortunately, Cliff Asness calls this volatility laundering. If you've got a portfolio of private company securities, whether they're bonds or stocks, and then you've got public corporate bonds and U.S. stocks, and you get into a recession, you're not getting that diversification benefit in real life. What you are getting is a delay between when you find out how much you're down. The private equity funds get to mark their portfolios periodically, whereas public stocks are marked to market every second of every day. But it's not like private equity is going to outperform in a negative environment or substantially outperform in a great environment. There's just sort of like a timing mismatch between when you actually learn what the pricing is.
Yeah, Josh, 2 more things on that too. First of all, you said 1% fees. That's being generous. That's like maybe at the top line what you're seeing. We all know.
You think higher?
It's obvious.
They're going to create new products though for 401ks.
Maybe, but you still know there's so many layers. There's so many hands in the pot. Like if you actually did forensic accounting on that, the fees would be really bad. One other thing that's very important.
Quick, please.
One of my family members just had another family member pass away. It was an 80-plus-year-old whose portfolio had been loaded up with these private vehicles, now passes down to the 3 kids, right? The 3 kids now all have inherited IRAs. They have all these private vehicles in them. They don't unlock for between 4 and 12 years. So they can't even access their money. I don't know why someone put an 80-year-old into these super locked up. Okay, fine, fine. We all do. And that goes back to the fee comment, right? And how many layers of fees. But I think there's a very pragmatic, very realistic downside to these, which is it's a problem. Like, it was easy enough to pass them down to the kids, but now the kids are stuck when they actually need that liquidity.
All right, Angelica. The latest edition of Josh Brown's Best Stocks in the Market list has a new entrant. It is?
TJX companies. This is not a big area of the market for me. I don't really talk about retail very often. This is an incredible long-term chart, an incredible long-term performer. I know Stephanie has been in this name for a long time and has been telling us about this company for years and years and years. But I'll make this very simple. You do have consumer trade down right now. They are looking for bargains. They are looking for discounts. TJX is the best of the discount retailers, the most consistent. The average discount range at their stores, whether it's TJ Maxx or Marshalls or Home Goods, is something on the order of 20 to 60% off a comparable full-price department store. So they're in the right they're in the right area of what the consumer is looking for and needs right now. Had a very good earnings report last quarter. They don't report this time until August 20th. But they did maintain their full-year guidance for comparable sales, for profit margins, for full-year earnings per share last May. I think that guidance remains intact. And I think what you're seeing here technically is a very obvious breakout. 135, 136, that was a ceiling back in March. If she can get through, I think that becomes the new floor. You've got moving averages turning up. And at the end of the day, what the market values most this year is momentum and consistency of earnings growth, and this thing has both of those in spades. So if you don't have retail in your portfolio, you're looking for a name that plays on what consumers are after in this day and age, this could be the one.
Stephanie Link. You used to be in this name, right? Way back when.
For a long time, right?
Made a lot of money in it.
Yeah.
Made a lot of
I actually
money.
had to do a double check and make sure you still weren't in it because I identified you in part with this name for a long time out of the retail space.
Yeah.
What about buying it back?
It's just a little too expensive for me at 29 times forward. But Josh makes all the relevant points. They are taking market share within the class that it's in, and they're taking share from the department stores, which are in a world of hurt, and they have elevated inventories, and they benefit from that. So management team is amazing, great balance sheet, like it. It's 29 times. It's very hard for me to own it.
Same CEO since 2016, Ernie
CEO.
Herman, and they figured out. They have like, it's like a Costco. To me, it's like a Costco.
100%.
And I'm jealous of you. I've never owned it. And give us a long-term chart, and then we've got to go to a break.
No, I got one more thing before we go to a break, but we can look at a long-term chart.
I want to see, I want people to understand.
You were good, not great with that.
Look where I'm discovering this stock.
Yeah.
You know, it's not a hidden gem, all right? It's not a discount.
During earnings, it always trades crappy. So you might get a look. Sometimes it's down 5-6%, so maybe you can get a look then.
Is the gap a hidden gem that has value, that you already own, and that you just bought more of?
Yeah, I do, and it's at 9 times earnings, and it's got a 3.5% dividend yield. And yes, you're going to hate the chart, Josh, but Richard Dixon is the CEO.
Oh my God!
And he is executing really well. They have gained market share for 9 consecutive quarters at Old Navy and the Gap, and that's because they have new leadership there. And operating margins have expanded the last 5 quarters. Gross margins are expanding. Inventories are in good check. Pricing power. I think they're doing a really good job changing the brands, and that's key. Athleta is the only one that's not doing well, and everybody in athleisure is having a hard time. So I don't really worry as much about that. But again, 9 times earnings. And oh, by the way, I think they de-risked the numbers because they gave us like tariff worst case scenario last quarter, and that's why the stock fell, and you can see the chart.
Yeah, well, the market's listening to you today. I mean, you know, the stocks that you are snapping up.
I don't know about that.
Scott, the market always listens to stuff.
Yes, clearly.
Let's be real.
Clearly. All right, Eli Lilly. Worst day in 25 years. Kevin Simpson owns it. Of course, we reached out to him, like, are you doing anything with this stock today? And he is. And he'll tell you what next. Choppy market lately. You see the Dow there down 350 points. NASDAQ's given up almost everything. It may actually be on your screens red now. It's looked barely green on mine. The market's been really choppy lately. as you know. We'll continue to follow it, but 355 down on the Dow. There's the NASDAQ giving everything back. I mean, Apple is positive again. NVIDIA hits a record high. Some of the chip stocks, despite those 100% threatened tariffs, are higher. But there are other names that are down reasonably significantly.
August. So, I mean, still in the,
Well, it's been a choppy market.
August.
It's been a choppy market.
Can I just say one thing on the choppy market?
Quick.
On these ugly down days,
Yeah.
I'm seeing the dividend stocks start to perform. And it's just really been super bifurcated. So on the big strong days, like wild underperformance in dividends, today, dividend stocks are up significantly.
Utilities are up
Not a little.
1.1%
Yeah,
as a sector,
not a
the
little.
best performer on the day.
Right.
All right, let's talk about Eli Lilly. I said it's having its worst day in some 25 years. Their weight loss pill showed only modest results in a late-stage trial. Market obviously did not like that. Kevin Simpson joins us now. We reached out to everybody in our universe who owns this name to see what was going on, and you actually are doing something. Tell our viewers what that is, please.
Yeah, I mean, just very briefly, Scott, the numbers were fantastic for the quarter, but that wasn't the story. Orforglipron and the failure to address the expectations for the oral drug have knocked this thing down probably about 14%, 52-week lows. So heading into this yesterday in the QDevo, we owned a 1.5% position. We thought the numbers would be better than they are today, but we were worried about the stock performance. You could see some volatility going into the trade. So yesterday afternoon, when the stock was $750, we covered a third of the position. In hindsight, I wish we had done more, but we wrote an in-the-money call for about a 1-week expiration. We brought in $38 yesterday at the close. And this morning, obviously with the stock down very substantially, we were able to buy those back and close them out for $1.36. So we hedged out $36 and change of the decline. Again, not anything to jump up and down about, but I think the lesson here is taking some activity and some hedging going into earnings sometimes is a really good idea.
Yeah, well, especially with the kind of decline you're looking at now. Kev, I got to run because I want to get to some other things. I appreciate you joining me and updating our viewers on your very latest move with Lilly. Again, the worst day in some 25 years. Take a look at Elanco as well today. Their earnings beat. They raised their guide. Stephanie Link owns that name and is pretty happy about it, to say the least, because that is the almost mirror image, or exact opposite, I should say, of what's happening with Lilly. It's up 16%. What do you think?
Yeah, I mean, it was a great quarter, too. They beat by 46 cents in earnings. Organic growth grew 8% versus the 4% expected. Companion animal was up 10%. Livestock was up 6%. They guided higher. They guided innovation growth and all of the products that they have to be higher in terms of contribution for this year. So it was really a great quarter. Stock's a little bit more rich these days at 19 times, but 8 times EBITDA. I still like it. I still like the animal health theme very much for the long term.
You got something on that? Oh, you looked at me like you wanted to say something.
No. Yeah.
Of course.
Do you have an animal?
Great job.
Do you have an animal?
Yeah, no.
Okay. Do you have an animal?
I do.
Do you
In
have
fact-
an animal? Like
No.
most people, 7 out of 10 people in this country have an animal.
Correct. And in fact, I've just
My
got a
wife
text
would
from
say
the
we
vet.
have an animal, but I am the companion animal in
You are
this case.
We're going to spend $150 billion
Yeah,
a
no,
year
it's a
between
huge
now and
market.
2030 on animal health and wellness. So I want to be part of that. Zoetis, IDEX, and Elanco are the only 3 that really exist with size.
Okay, let's do finals. Jenny Harrington,
Okay.
you're first.
Great numbers. Flex LNG up 10% on the year, 12% dividend yield, 13 times earnings.
Steph.
Palo Alto on the bad Fortinet news. This is not Fortinet.
Ooh, Fortinet's getting hammered today, too. We can show that, too. Apple. You, Josh?
Yeah, I think it's 200 looks like the lows are in.
All right,
So,
I'll see you on the bell.
Hey, I'm George. This is Blue Cloud Trading. We just saw Josh Brown and a number of guests on the halftime report earlier today. It's Thursday, August 7th. Right now it's after the close. So it is actually 4:23 p.m. as I'm recording this video. And we can see what happened in the markets. The Dow, okay, it gapped up in the morning, dropped, and then around 12 p.m. it kind of basically stayed in this level right here, down 0.51%. NASDAQ also dropped, but actually closed up just slightly, 0.35%. S&P 500 just, gapped up in the morning, but then started dropping throughout the day, and then finally closing just under yesterday's closing price, down 0.08%. Russell 2000 dropped, and that was also down 0.33%. In this video, what we're going to do is we're going to take a look at the stocks that they discussed on the halftime report, some of them, not all of them. And so you can see like TJX, for example, Gap, Eli Lilly. We're going to also look at the index ETFs, including the European one, FEZ. We're going to look at 3 of the Mag 7 stocks. We're going to look at some of the strongest sectors, and then we'll also take a look at one of our members' requests. So let's first, though, before we do that, let's take a look at the heat map. And this shows us the individual stocks in the S&P 500, how they performed today. You'll see that Apple was up 3.18. Some of the semiconductors were up. NVIDIA was up. Broadcom was up. So the semiconductors did pretty well. But financials, all in the red there, the majority of them. Eli Lilly was down 14.14. We're going to actually look at that stock in a second. And utilities were up. Let's look at the groups. So this is the sectors, right? And what we see here for the one-day performance, basic materials, utilities, consumer defenses were up the most. You had financials, healthcare, and energy down. All right, and this is the 1 week performance. So let's get into these. And we'll start off with the S&P 500 first, and then we'll get into some of these other things that we just talked about. So here's the S&P 500. Let's make this chart a little bigger. What we're doing here is we're using the Ichimoku indicator. You might be new to this channel, may not be familiar with this, but it's a Japanese indicator that helps us to quickly identify the strength of the trend of the market or stock or ETF. It doesn't really matter. And we can switch it to different time frames. Like right now, we're looking at a daily chart. Each one of these Japanese candlesticks represents a day. And if it's red, that means that it was down that day. It was down 0.08%, but the price did remain above the moving averages. So the moving averages are the 9 period, which is that green period, the green line right there. You've got the red line, which is the 26 period. Okay, so this one's called Tenkan-sen, Kijun-sen. And then we also have the Ichimoku cloud. And the Ichimoku cloud consists of the Senkou span A and the Senkou span B. And we want that Senkou span A to be above the Senkou span B. We want price to be above the cloud. Okay, we want it to be above the moving averages, which it is. And then there's one last element, and that's the Chikou span. That's that white line there. That's the closing price. Today's closing price projected 26 periods into the past. And if that white line happens to be above the candle 26 periods ago, that's very bullish for the market. And you can see we've had a very bullish market here for a while now. If we go back a little bit in time, you can see that it's not always that way, right? Over here, for example, you can see where the Chikou span crossed under the candle right there. That was back on January 17th. If we project that 26 periods into the future, we would have got that message or that right there on that candle. Now, everything looked pretty good, bullish, as far as price being above the cloud, the moving averages, but that was the first key before things started to go negative, right? And it just basically, you can see how the market dropped about 20.29% from that, around that area. It's about 20% or so. It's not 100% foolproof, but it is something to pay attention to. It's one of the elements of the Ichimoku. Anyway, so far we're very strong both on the daily and the weekly chart. You can see that right there. And that is, by the way, the cloud itself, it projects 26 periods into the future, which is kind of unique also. So that's why it's got a blue flag. So if you see some stocks and ETFs here that have a little blue flag, that means that they are bullish on both the time frames, the weekly and daily. All right, so here's the QQQ ETF on the weekly chart, very bullish still, up 0.34% today. Bullish cloud here in the weekly. Daily, same thing. All right, even though it was a negative candle, it did remain above the moving averages and was actually up 0.34%. The VIX, which represents market volatility, is still, at these healthy levels of around 16.57. We didn't see a big dramatic change on August 1st. We saw a slight little spike here. You can see that right there after the, we were expecting the earnings, not earnings, but the announcement regarding tariffs. Apparently, Wall Street is just, kind of taking all of this information, and it's just not paying attention to it anymore. At this point, it's not really having an impact. We might see some impact, down the road, maybe 3 months, 6 months from now. But right now, the market is still relatively steady, as you can see. We want volatility to be low. We don't want it to be spiking like it did back in April, because that tends to lead to a downward trend of the markets. Russell 2000 down 0.29% today. Does not get a blue flag because the faster moving average here, which is the Tenkan, is under the red line, the slower one, the 26. So price is above the moving averages. It's above the cloud. Let's see, the Chiku span is still above price. On the weekly chart, though, we're inside the cloud, and that's not a bullish place to be. That tells us there's indecision still with the Russell. FEZ is the Euro stocks. Now, on the weekly chart, looks very bullish. Last week, it actually closed, as you can see, under the 9-period moving average. And then today, I mean, not today, but this week, it gapped up on Monday, and it's continued to move up. It's up 1.37%. So the Euro stocks are doing quite well for the week. However, if we look at the daily chart, okay, even though it's gapped up, we've got a few signs of weakness here. We've got the faster moving average under the slower one. So it's not foolproof yet. And so we also have a bearish cloud that's formed here. Take a look here into the future, and you'll notice that the Senko span A is under the Senko span B. The light colored blue line is under the purple one. So that's not also positive. All right, well, let's keep going. DIA is the Dow Jones ETF. Here on the daily chart, you can see we have a bearish engulfing pattern. It's when you have a small candle followed by a large red candle that engulfs the prior one, and it's red, like you see right there. Down 0.51% on the daily chart. If you want to see what that looks like real quick here on the candle pattern reference sheet, it's under the double candle patterns. This is what it looks like, bearish engulfing. Small bullish candle followed by a large red candle that engulfs it. If you're unfamiliar with candlesticks, this is a good little spot to check out. Opening price, closing price, that's a green candle. If the opening price is at the top of the body and the closing price is at the bottom, that's a red candle. The wick represents the highs of the day or week, whatever it is, what time frame you're looking at. The wick on the bottom represents the lows. But then this is the closing price here for the red candle. This is the closing price for the green candle. Okay? And that's how we can quickly identify what's happening in the markets. And that's also Japanese. Japanese have done a pretty good job at putting together very visual ways to observe the markets. And Ichimoku in Japanese, stands for at a glance. We want to, at a glance, be able to quickly identify the strength. And right now, there's weakness here in the Dow. You can see that. All right, let's take a look at some of those stocks that they talked about on today's halftime report. TJX is a stock that Josh Brown mentioned he likes quite a bit. Looking at the weekly chart, I'm liking this too. Now, I had a position in this back in April. On April 17th, I closed out of it on May 20th for a 6.4% profit. It really wasn't that big of a profit, but right now we're starting to see strength again coming into this. And you can see on the weekly chart, it's broken through prior levels of resistance. It's above the moving averages. On the daily chart, same thing, but it was down 0.08% today. All right. So, yeah, at this time, I would not be adding a position because of the type of candle that's formed here. It's a little bit far away from the moving averages, but I do like the overall trend of this market. You can also notice down below where Senko span A has recently crossed back above the Senko span B. So that's also bullish. What about Elanco Animal Health Incorporated? This was the stock that Stephanie Link made a nice profit on. It was up 18.14% today. The earnings announcement came out and it did quite well. Notice also that it was finding support right there at the cloud prior to this, right? So as the buyers and sellers were waiting for the announcement, and then usually when there's an announcement, you're going to see a gap either to the upside or to the downside, depending on the news, right? So it's always kind of unpredictable, but the volume has been increasing steadily. Positive DI is above the negative DI, so it's looking good on the daily as it broke through some levels here. It's not experiencing all-time highs. The all-time highs were back here in 2024. It was $18.82. I don't know how long she's been holding this position, but lately, obviously since it broke through the Ichimoku cloud, and I always recommend that you wait until it breaks through the cloud, because if price is under the cloud, notice how long it can stay and remain under. It becomes embedded, essentially, under the cloud there. And so once it breaks through, Okay, now all of a sudden there's a lot more interest. Look at the volume bar down there. Do you see that? That also correlated with the break through the cloud. And then you can see that price moved up, pulled back a little bit, found support at the cloud, and bounced. Okay, so that looks good. Here's the weekly chart as well. Also breaking through the cloud on the weekly, right? So where it was finding resistance here at the top of the Ichimoku cloud on the weekly, these are all weekly candles. All right, 4 weeks in a row, it touched the top. And then finally this week with the earnings announcement, with the high volume, okay, positive DI moving back up again, negative DI moving down, that's positive. Breaking through that 200-day moving average, that dotted yellow line that you see right there, that's very bullish too. It's going to take and then also the cloud has turned bullish on the weekly. So I like this one, Elanco Animal Health Incorporated. Okay, let's continue. GAP. This was Stephanie Link's final trade back on May 30th. But I forget who liked this one. I think they just brought it up on the show. The bottom line is it's not something I would be touching at this point because it's under the moving averages. You can see here under the declining 200-day. You can see the 200 is actually sloping down. And yeah, we've seen 4 or 5 days of price moving up, but that's not conclusive. Let's take a look at the weekly chart. All right, there's the weekly chart too. And although we're creating a bullish double candle pattern here with a bullish harami, we don't know yet. There's one more day, Friday, before this is develops, but we're still under the cloud. So I'd skip this one. I would not be adding that particular stock. How about Eli Lilly, which had a big drop, 14.14%. That was Kevin Simpson's final trade back on March 13th. And let's see, when was March 13th? It was around this. Let's put the daily chart on. Let's take a look at that. March 13th is when he was recommending it. He was recommending it right about there, around this level. Not a level that I would have added it because it was under the 200. It was under these moving averages here. Bottom line is, and let's look at the weekly chart on Eli Lilly. On March 13th, where was it? Let's see, March 13th. March 13th would have been around on this candle right here. That was the week ending March 14th. So it was inside the cloud at that time. So I would not have recommended that. Okay. Notice from that part right there, from that opening price of that candle, it dropped 24.6%. So the Ichimoku cloud is really good at quickly identifying what's really happening behind the scenes as far as the buyers, the sellers, and it can help give us a little more, of a higher probability trade. It's not guaranteed to to work out every single time, but you're gonna have a higher probability trade. That's the key that we're looking for. We want to have an edge in the market, essentially, and that's the kind of thing I teach. And if you're interested in becoming a member, consider that. What you'd want to do basically is come to my homepage here, Blue Cloud Trading. All right. If you haven't subscribed yet, hit the subscribe button. And then after that, you can click the join button here. That's that link right there. If you click on that at the top, it will bring you to this a little box should pop up. There it is. Membership, 3 levels: Blue Cloud Supporter, Blue Cloud Trader, and Blue Cloud Legend level member. Now, under this level, you're supporting the channel. You can request a stock to be analyzed in the show on an upcoming episode. Blue Cloud Trader, yes, you can do that too as well here, but you'll also get access to exclusive member-only videos. All right, now those are important. Those are the videos that I do each weekend where I go over my entire portfolio and I share why I'm entering, why I'm closing out of positions, and basically just, you can see here every week there's another video popping up. And then if you want to go one step further, right, there's one more level, and that's the Blue Cloud Legend level membership. So that would be this one. So you have to select that, and then hit the join button. If you just hit join, it will automatically bring you into the Blue Cloud Supporter. So make sure that you select the proper one, the one that appeals to you the most. Under Blue Cloud Legend level membership, you get all the other perks from the upper ones, but you also get access to some day trading videos I've recorded, as well as some daily trade updates. And the daily trade updates are basically I'm giving updates on my trades each day, and I'm posting them. Right next to the posts, there will be a new tab that pops up after you become a member. It will say membership. You click on that. That's where you'll see the daily trade updates. I usually update my trades between 2 and 4 p.m. Eastern time before the market closes every day, Monday through Friday. All right, and then I go over, of course, all the trades in a summary video at the end of the week. So let's get back. So we talked about Eli Lilly, not looking good on the weekly, not looking good on the daily. Stay out of that one. That's my recommendation because you don't know how much further this thing is going to drop. FLNG is Flex LNG. Let's see here. That was Jenny's final trade today. So it looks good on the daily chart. Okay, we've got a bullish cloud. Chico span is above the price. Tenkan-sen, the 9 period is above the 26 period. It's above the 200-day. It seems to be consolidating, creating a little bit of a box right here, box type situation. All right, so these last, I don't know, how many days is that? About 8 days or so. It's been just, staying within this range. Now, ideally, you want to wait for it to break through, but then you'll have resistance at 2650. That's the weekly level. All right, right there. It's also on the weekly chart. It's inside the Ichimoku cloud. So another stock I would not be recommending based on that. Ideally, what you're looking for is a stock that, or ETF, that is strong on the weekly and the daily, 2 time frames, the longer term and the shorter term time frame. You'll have a higher, again, probability success ratio with your trades. Let's keep going. PANW, Palo Alto Networks. Okay, Stephanie Ling's final trade on August 7th. Now, on the weekly chart, down 2.77% today. This is the weekly chart. You can see last week it re-entered the cloud. It was looking good back here on July 25th. It stopped looking good on August 1st. And right now it looks like it's actually getting under. It actually got under the cloud today. We won't know exactly for sure what this candle looks like until tomorrow, 4 p.m., but it's not looking good. Okay. Here's another thing I like to use. I like to use the directional movement index indicator. I've got it at a setting of 9, and I also superimpose the ADX9 on top of that. So the directional movement index just tells us, okay, if the negative DI, the red line, is above the green line, that's bearish. And the white line is actually it's basically agnostic is what it is. It doesn't really care about what's above. If the green line is okay, what this represents is the momentum. All right. And so when the red line is above the green line and the white line is moving up, it's telling us that the momentum is increasing, but it's not positive for your stock. It's dropping. Okay, so it's dropping with more momentum to the downside. So therefore, I wouldn't recommend this one. Here's a daily chart. Whoops. You can see that even more, right there. Look at that. You're seeing the same thing here. An increase of volume here happened on July 29th. And then although the volume did come back out, it's starting to come back, becoming negative again here today. So no bueno on this one. PANW, stay out of that one, folks. Let's take a look at some of the Mag 7 stocks like Meta, which is, here it is on the daily chart. It's above the moving averages, but it's kind of like building inside a symmetrical triangle type situation. So overall, I like Meta, but I probably want to wait for it to break through this little consolidation area. I did give a blue flag because it does look strong on the weekly chart too. There it is. You can see it broke through this prior level of 740.91. It's holding up above it. The cloud's bullish. Everything looks good still. Apple, on the other hand, on the weekly chart, although it was up 3.18% today, this is the weekly chart, you will notice that price is still under this trend line, this yellow line. You take that high, draw the trend line, look where it's coming, right to it. Let's look at the daily chart. And plus, price is inside the cloud. It's also bearish. Look at the daily chart. Yes, it's been looking pretty bullish these last 2 days, right? But what about the prior days? Okay, so, and yes, it started to show a little bit of strength here on the daily chart because it bounced off the cloud. The problem that I see with Apple technically is the 200-day is right there. So that's interesting that on the daily chart, the 200-day moving average is right there. It's right at that level. And that trend line that I just showed you from the weekly chart is still in play. Okay, so I would not recommend this one, even though it's starting to show a little strength because, yeah, it doesn't look good in the technicals. All right, Tesla. Let's start with a weekly chart. Kind of similar concept here where we've got a trend line where price is underneath it. It's re-entered the cloud. It was up 0.74% today. Let's look at that daily chart. Also right under that 200-day, which is interesting. All right, once we break through these levels, it's a different story. I'll give you guys an update on that. I might even consider adding one or two of those. Who knows? You never know. Life is unpredictable. Silver, SLV. Let's look at this one on the weekly chart. Here it is, holding up above the moving averages, looking pretty bullish here. I like silver, SLV. These are the strong sectors here, the strongest ones I've got right there with a little blue flag. On the daily chart, prices above both moving averages. One thing I'm concerned about is the fact that the Tengen-sen is under the Kijun-sen. But I do like the fact that the ADX has stopped dropping. It's starting to flatten out. Positive DI is moving up. Negative DI is moving down. This is actually bullish. It was up 1.19% today. And of course, if we look at the weekly chart, like I said, that's another reason why I kind of like it still. It's not as strong, though, as GDX, which is the gold miners ETF. On the weekly chart, it broke through this consolidation area. Okay. And on the daily chart, it's been moving steadily upward. You can see that looks more bullish, up 0.96%. It does concern me this last day right here today that we have this type of candle, because what it represents is it's almost like what they call a doji, which is showing us that price opened and closed around the same place. It didn't move up as much as the prior days. Notice how this candle was a bigger candle. The second one was slightly smaller. The third one, same thing. And now it's kind of almost like price is getting squeezed in to these levels. So I'd want to wait and see what happens. If it drops under the low of that candle, it could potentially pull back to the next level of support, the moving averages, or this little box that you can see here that's been drawn based on these levels. XLK on the weekly chart, looking strong. ADX is moving up. So I like this one on the weekly. Daily chart, also looking pretty good here, up 0.09%. We got a slightly negative candle, but it's holding up above moving averages. And what about Bitcoin today? On the weekly chart, okay, 117,507 is the price today. I like that it's bouncing off the 9 period on the weekly. On the daily chart, it's also broken through the Tengen-sen Kijun-sen. That's also bullish. But the problem here is it is still kind of stuck under this little trend line. Do you see that right there? So we might need to see a little bit more confirmation here on Bitcoin. A breakthrough would would make me feel a little bit more confident. Utilities on the weekly, XLU ETF up 1.09%, looking good. On the daily chart, also looking good. I like it. XLY, another blue flagged ETF, holding up above the Tengen-sen Kijun-sen. It was down just slightly, 0.03. That's the consumer discretionary. Here's the weekly chart, still holding up above the cloud. And we do have a bullish cloud still right there. IBIT is the ETF for Bitcoin. And there's that trend line that I was talking about. There's the weekly. There's the daily. Yes, it got above the moving averages. It looks like it's going to pop. But I'll wait. It was up 2.01%. What about GDXJ? Let's look at the weekly chart first. This one's looking good. So this week it's gotten above the Tengen-sen on the weekly. On the daily chart, also looking very strong. It seems to be losing a little bit of steam here towards the top, but it could certainly continue moving up. It's had a nice little run up here. Let's see if it will continue. It actually broke through this high right here, these highs right there. But this candle is not a really extremely bullish candle per se because of the size of it. So we'll see if it can continue moving up. SMH. That's a semiconductor ETF. We saw how semiconductors did well today. They basically price gapped up. But if we see how it's negative, what that means is like throughout the day, even though it was up, like if we look at a 5-minute, for example, it gapped up. What happened was it steadily started to decline throughout the day. So you can see that right there. Then it went sideways. It actually started developing, like this lower high from the prior one on the 5-minute. And then, but then an interesting thing that happened in the last 5 minutes of SMH is you can see it broke above that little high right there. So it happened on high volume. Many times it's because, traders are like taking profits towards the end of the day. So inconclusive, but I do like the fact that on the daily chart, it's still holding up. Let's look at, okay, so I'm not going to cover the other ETFs because I already reviewed them and they're missing some things. They're not the strongest ETFs to be paying attention to at this particular time. AbbVie, ABBV, healthcare sector, drug manufacturers. Here it is. Let's start off with a weekly chart. This is one of our members' requests. And this one here, it actually is still holding under this level of resistance. Do you see those two candles right here? Okay, that goes back to May, or the month of May. And so we've been just consolidating. We've been stuck in the box, basically. Ideally, you want to wait until it breaks through that 198.98. Here's a daily chart. You can see that it's showing some strength. We got a bullish cloud. Prices above the moving averages. Chigu span is right there. There's the high right there that the high of 198.98. That's from May 2nd. That's the level that needs to be broken. Right now we're at 198.86. We're not that far away. So one bullish day can pop it through, and then I think it will look good. The only problem with, considering AbbVie at this particular time is if we look at just the XLV, healthcare ETF, it's not looking that healthy. No pun intended. Okay, so it's under the cloud on the daily, on the weekly chart also. All right, so let me check one more thing. Okay, so I have, one of the cool things about this platform that I'm using, it's called TC2000. It also has its own sector sort of symbols. All right, you can see the utilities, technology, basic materials, and healthcare is in there. See how it says SX60? So we're getting a much bigger, more broad group of stocks that are within. There's about, I'm just going to show you how it shows the stocks over here that are within it. There's around 1,162. I don't know if you can see that in the bottom right there. Let me show you the, oops, excuse me. Right down there, 1,162 stocks. So that's what we're looking at here. We're getting a much bigger, more broad group of stocks within the SX60. You can't really trade this. It's just a way to quickly identify how the sectors are doing. And each weekend when I do my analysis, I'm doing a thorough analysis of the sectors, and I'm recommending specific sectors. Like this week, for example, I recommended utilities and technology. Okay, for this week, based on the information that I had from the reviewing, basically. And then beyond that, there's also the individual industries within each. So utilities might have these industries. Okay, so you've got your utilities, independent power, diversified regulated electric were the ones that I had highlighted. And under technology, you can see the electronic gaming and multimedia. Okay, and then you can actually look at the chart of electronic gaming, which is kind of cool. And then it will only pop up the stocks that are within there, which is interesting. So each thing will pop up its own stocks based on the industry. So you do a drill, they call this the drill down. And if you basically use the software, it's already preset, so you can look at these. You can also set up a chart in the center like I have, so that you can, as you're looking through the different sectors, you can kind of get a sense of how they're looking. But healthcare on the weekly chart here, the SX60, you can see it got back inside the cloud, so it's starting to show a little weakness now. And on the daily chart, it's also under the moving averages. So I would not recommend that stock that we just covered. Hold on, let me go back to it. AbbVie, just based on that. Okay, because the sector and the industry can sometimes draw down the stocks, even if they're strong. All right, you're going to have a few stocks that are popping, even within some of the weak sectors. But yeah, I mean, if you really like the company, it's a different story. But right now, I would not be recommending it. Anyway, that's going to do it for this video, folks. By the way, if you want to get access to this software, there's a $25 coupon for this with a link. There's an affiliate link. Again, come back to this homepage here, Blue Cloud Trading, where you can become a member. But right next to it, you'll see this. It says, and 9 more links. And you click on it. Get a description of the channel. Scroll down. Here's the link for the $25 coupon for TC2000. You click on that, brings you to this page with the homepage of TC2000. And you enter your email here, and then you can download it for Windows. And as you can see here, you will receive a $25 coupon towards your service, courtesy of Blue Cloud Trading, as long as you have not used the service in the last 12 months. And then what else? Here's the pricing information. And just select monthly if you want to start off with monthly to practice. So like, look, you can even use the silver for a couple months for free, since it's only $10 a month. I would strongly recommend that you actually start off with gold, though. Pay that $5 out of pocket after using the coupon. And why would I recommend this one? Because there's so many more features in this software. For example, one of the things that you'll be able to do is, as you can see, these are the little dots that represent what you get from all the features, right? So you'll be able to filter and sort watch lists. Whoops. Create conditions. Monitor the most watched and trending stocks. Hide and show stack watch lists. You can drill down through sectors and industries. So what I just showed you, which is how you can drill down. The drill down, you won't be able to access that with the silver. You'll be able to add fundamentals at the top of your chart, like I do. Let me just show you that again, what it looks like. See how I have these up here? And you can add whatever you want, actually. You can, like, if you right-click and you hit Edit Toolbar, okay? And then let's say I wanted to add another row. I could click that little plus button. Now I can scroll down and look at all the different features that are available here. Capitalization, cost of sales. I mean, there's tons of stuff in here that I can't add everything, but you can put some of your favorites, maybe it's the PEG ratio, price to sales ratio. I've got that one. So let me show you what that looks like up here. There it is, price to sales, 5.63. PEG, 1.34. Sales growth rate, 5.93. Operating cash flow, the EBITDA. When's the next earnings announcement? You can add all that stuff. That way you can quickly, you'll know exactly where your stock stands. I don't think I've seen any other charting platform that has the fundamentals, like, right there on the chart, where you can quickly assess it as you're skipping through all the different charts. Anyway, that is going to do it for this video. Thank you guys for watching. I appreciate all of you. Like, subscribe, and share this video with someone that you think might like it to help support the channel. And I will catch you all in the next video.